What's up everybody, Choi Boy here. Good news today, I hit $1,000 on Sharesies. That's really good news, especially it hasn't even been a month since I've started adding money to my Sharesies account. I did have my Sharesies account for quite a while. I mean, I had it since 2017, but I just never used it. Didn't have many funds back then and stuff like that. Finally started using it mid January, looking pretty good, still negative. I am not timing the market and I am mostly in funds and a few companies. I guess I'll grow the companies part and add a bit more, but for now it is a bit negative. But for 1,075 bucks, not too bad even within a month. That number used to be a bit bigger, so the total returns was like negative 20 at a certain point. That's like when I bought all these healthcare companies, and I had a second thought and I was like, oh, I'm gonna sell my AFT and my Oceania healthcare. I don't know, like in the short term, I think people will be taking profits and stuff like that. So I just sold it right away. I'll show you what I mean. But yeah, it was just like the gap just started growing. It's like negative 24. Then I added like a few hundred more, like 200 more bucks, and it just recently closed off thanks to my funds. My funds are relatively positive or even right now, which is really good. Let's have a look at them. For example, US Large Growth Fund is the one I have the most of, and so far it's a pretty good return. I mean, it's been less than 1 month and I'm already $7.33 up from only 2017. No, not 2017, 217, and that's roughly around 3.49% return within 1 month, like 4 weeks, and that's pretty good. That's pretty good. And as I said, there's a few ones that are like pretty even, 14 cents, not much. 80 cents. So for example, NZ Property Fund, that used to be the funds I had for my Australian financial funds, but I sold that. I had second thoughts about that and I was like, don't really feel it, let's not. So I sold it and I bought property fund with all that money, and it's doing even, not too bad. Australian financial one, I think it dipped a bit, but yeah. NZ Dividend Fund, that's the one I have the least of. It's just a bit lower risk and the annual returns is a bit in the middle, so I just put a bit into it. I am a bit on the aggressive side for investments in general, even for long term. I like to go pretty all out on the while doing some risk management and stuff like that. But you know don't take everything I say for financial advice. It's not. It's just purely my opinion. I'm just adding to your research. Do your own research, just so you do the right thing for yourself. Just sharing my knowledge and sharing my stories with you doesn't mean you have to buy them. Going to the companies, Fletcher Building, Infratil, they're doing so. I mean, I put $50 each, but companies have like additional fees on top of it. Like for example, they have things called transaction fees. It is quite a bit, and you start with like a few cents off or like 10 cents off and stuff like that as soon as you buy it. I mean, you got to think about those kind of things when you're trading companies shares, because they have transaction fees. And you got to make a profit. If you want to make a profit, you need to cover those fees. It's not much. It's honestly not much. If you choose the right companies, then the profits will easily cover the fees in the few days or something even. It's not much at all, but that's just something you should be aware of. Picture Group, my previous company, I asked the CFO if it's fine to buy them. He said it's totally fine, so I'm perfectly legal to buy the shares, and it's honestly a great company. Once again, not financial advice, but they're doing me pretty good so far. $3 from $101 and 3.19%. I think they're doing pretty good. They recently, the CEO of this company announced that they have a new CTO, and the CTO is coming from Nike in the US, I think. I don't know, but he was like an executive team or something like that in Nike and stuff like that. And he also worked for Microsoft Studios and stuff like that. A lot of interesting things. I think that's a pretty good change. It is always quite shaky when the executive team changes in a company. For example, Plexure getting a new CTO, but in the general things, I think it's a good change, well-deserved change. I think it's a positive one. So pretty bullish on that one. Z Energy, it's a tricky one here. I mean, I only bought it because the dividend yields is not too bad. 14.8%. It's not guaranteed. It does not mean I'm going to get 14.8% if I hold this. But yeah, the main thing is that fuel companies will last for the next few years at least. It's a bit low. And I think because I think it's gonna manage well for the next few years and the next decade for something like that. So yeah, buying them pretty low and seeing where they go. Honestly, if they continue to just eventually I'll probably sell and do something else with it. But yeah, probably not gonna add too much into Z Energy, maybe just a bit, so I can get a piece of that dividends. But yeah, I'm currently doing 200 a week, so 200 auto payment into my Sharesies account and to the wallet. And there's a DIY order, which just my funds. I only have 4, so meaning I do have a bit of an actively managed kind of portfolio here. I don't keep the same ones. For companies, I change it around every now and then, and I will. And funds as well, I think I'll be adding a few more funds and taking some of them out if they're not looking good at certain point. Like for example, if NZ Dividend doesn't seem worth it later on, I might change that to another one. Really, it's quite flexible, so I like to keep it quite flexible for myself, just so I do risk management and risk to reward ratio, stuff like that. It's just more fun that way, and investments should be fun. You should be learning something from it, and it should be fun. I think that's the most important thing. US Large Growth Fund is my largest one. It is one of the highest annual returns. They don't pay dividends, I think, but the share price just been booming. So yeah, they're doing me really good. So 40% on that, 25 on the top 10 and property fund, and dividend fund only gets 10% of my 150. So I said I put 200 bucks, but 150 goes into funds, and it's being split by those percentages, and the 50 bucks that's remaining every week, I just chuck it into a company. And I just, I might buy more Plexure or buy another company. I'm looking into expanding into some large cap companies like Fisher and Paykel Healthcare. It is always kind of hard. It's a hard choice when a company is just always hitting a new high, especially that's the case for Fisher and Paykel Healthcare. Yeah, it's just constantly making new highs. Honestly, you just don't know what's going to happen, but I think it's not a bad idea to mix in some high caps. High caps are pretty appealing just because they're not as volatile and they're a bit more, they have a good track record, and it's always a nice peace of mind. But as I said, I sold my AFTs. Yeah, I sold this. I bought it here and I was like, 3 days later, I was like, second thoughts. I was like, that looks, doesn't look that great actually. And I changed my mind and I sold it. Thank God I did, because it just dipped a bit. Same with Oceania. Yeah, this one as well. See, I bought it at the same time and I sold it at the same time. I was just like, yo, this doesn't look good as well. This just doesn't. I just felt it. I was just like, nope. I just sold it. So I just sold it and I bought the Plexure and what was it, Fletcher and Infratil. I bought it with those ones that I sold. So for companies, I like companies that don't have much competition in their sector, or they just have a really big advantage over the rest of the companies in the same sector. It's just because it's a bit more safe that way. The less competition there is, the more, you're the sole driver of the sector, and if the sector is doing pretty good, you are going to be doing really good as a company. So that's what I'm looking for in general. Like for example, like let's talk about healthcare. It would be Fisher Paykel Healthcare. For energy, it will be Meridian. It's the largest cap in the energy sector in New Zealand, and mainly because they are pushing like a lot of renewable energy and stuff like that, and it's just it's a better choice than Z Energy for the long run, to be honest. Z Energy is probably a very short-term thing, like 1 year or something like that for me. We'll see about that, but like that's like the kind of things you'd be thinking about just doing research. For example, like airport is a nice one. I actually really like the Auckland International Airport because there is no other airport in Auckland. I mean, these guys are like the only ones that do any international, especially in Auckland's the busiest one. So, it's quite a good one to buy. For example, like the ports are not too bad as well. Like, let's have a look at the Napier port. How is it doing? It was doing alright. It kind of dipped a bit, but let's have a look at the port of Tauranga. Port of Tauranga, it's been doing alright. It's dipped a bit recently, but no worries. In the general trend, it's looking pretty good. Had that little nice spike there in the end of last year, but yeah, that's pretty much what I'm gonna do. So probably look into maybe another fund, or mainly gonna be looking for a few more companies. I am gonna be increasing my weekly to $300 pretty soon. I've been doing some calculations on how much cash I want to hold in my bank account versus how much I want to invest every paycheck. And I think I'm pretty flexible, and I think it'd be pretty nice to have a bit more in investments. I mean, cash is I don't really like it, especially with the all recession talk and stuff like that. If it actually does happen in the next few years, then having cash is not good, because inflation, when the government and the central banks, if they start printing money, you're pretty much screwed, because it devalues the dollar. And the only things that goes against it is like bonds, investments. I mean, investments tank during a recession as well. So bonds, gold, and stuff like that, people just buy things that just retain the value. Roughly going to talk about a few things before I finish the video today. It's about compound interesting. Why do we do long-term, right? Long-term investments is frequent dollar cost averaging. Just keep doing it until you hit a certain goal, or do you just keep doing it until you just take it out at a certain point? It could be for retirement, it could be for your first house. It really doesn't matter, but you would normally want to keep it for at least 5 years plus, honestly. For example, for me, I'm turning 24 this year, and let's say until 30 years old, I do $200, which is what I'm doing right now, weekly. Let's say I do that for 6 years, 200 a weekly. And let's say I actively manage my thing. I constantly change it around, and including my funds and companies shares. So let's say I'm looking at 20% interest rate per annum, which is per year. That's quite hard to reach sometimes, especially if it's a bad year, and if one of my years are really bad. Like for example, if a recession comes and if I don't take anything out, then it is a negative year, negative returns, and it is quite risky. But let's say I manage that all well, and I risk manage it all well, just to average around 20%. Pretty high, pretty high goal. But if I manage to do that, I'm only putting 59k, but I get back 41k. It's nearly a double of money. That's a whole salary there after tax. Pretty good. But if I increase that to $400, which, if as my salary goes up, I will be investing more, because my expenses will not grow as much. My regular expenses will not grow as much, just because I earn more. That means I have more money to invest. So I'd be doing that, and maybe even like 500, but even $400, I'll be putting 117k in, and compound interest would give me 83k back. And you are always reinvesting money. That's what compound interesting is. Compounding is another word or another term for it. So pretty much what you're doing is you are not taking any of the returns and putting into your pocket. You're pretty much reinvesting that money back into your portfolio, and that's really the important part of compound interesting, because when you first start, you don't get that much of a difference, but as you go on, like as 1, 2, 3, 4 years, every year, the amount of money your money makes is crazy. Because pretty much what you're doing is you're getting the money that you earned from your money, and you reinvesting that money into your heap for that to also generate money. So the more money you're just adding, you're just adding your gains back into it. It just grows really, really fast. After like the 10-year mark, it just grows like crazy fast. The most important thing is your contribution rate. Do contribute as much as you can on your own scale. For me, I tend to be investing around 40 to 50% of my cash remainders and my savings, pretty much whatever I don't use, and that's not a bad mark. As the salary goes up and the pay goes up, you might not need that much cash savings at a certain point, and you just want more investments, and maybe you have like 60-70% on investments later on. That's totally up to you, but the more you contribute, compound interest is a beautiful thing. That's like the beauty of long-term investments on ETFs, pretty much. It's just really, really good. Like 147k of your own money, and you get 100k back. Unrealistic 20%, but that's a goal, only if you actively manage it, or if you just happen to choose really, really good funds, and they just don't go down in value, and they just keep a really good high annual return every year, then yeah, sure, possible. But is it likely, especially with all the talk with the recession coming soon and all the noise everywhere? Who knows? Roughly touching on that, the US economic expansion is the longest one right now. It's well over 120 month. That's more than 10 years, and normally we're talking about 8 to 12 years between each recession. We're on the 12-year mark now, I believe, because the last one was in 2008. That was the US housing crisis, and before that was the dot-com bubble in 2000. So 2000 to 2008 was 8 years. 2008 to right now, and who knows, we might be in a recession. Recessions are not easy to identify until you're like in the middle of it. There's a few indicators of a recession, but right now it's looking pretty good. But who knows? Later on we might not even know in a recession. It's a very complex topic. So that's how it's looking. But yeah, it's definitely the longest expansion so far. There is a bit of decreased growth in like GDP and jobs and stuff like that, and there's a bit of controversy around like trade wars starting. They actually weren't too big, but like the US and China one, and the South Korea and Japan one as well, is a bit of a trade fight there. All these kind of things, and every recession there's a few countries that get affected the most. I think a lot of European companies are not looking that great, especially with UK as well, with the whole Brexit kind of stuff going on. You know, a lot of controversy going there as well. But it's a hard one. It's a very hard one. But every time a recession does come, the share price and these funds tend to go down. So it's dot-com bubble, it went from like 1.5 to like, I don't know, 800. The US housing crisis, the 2008 one, it went from like 1.5 down to like 700 and something as well. I think like 773 or something like that. So it like pretty much halved in prices. But you see that massive growth here. That's a pretty big growth. That's a exponential growth, nearly. I don't know. That's a crazy growth. See, in the past two recession, it stayed around the same levels, but after the 2008 crisis, it just kicked off. Totally just kicked off. That's totally not scary, is it? It's scary. It is quite scary. But I'm willing to take the risk to squeeze out a bit of the last few years, depending on when the recession will come, the last year or two of gains. Because it just does this until it hits that recession, it just goes down. But just before like a year or two before the recession is like the sweet spot where everything just starts pumping like crazy, and that's where everything becomes unsustainable and it just corrects itself, right? Correcting meaning it just the price goes down a bit and people start taking profits, and they start be like, oh, my wealth is lots of them in the stock market, I'm gonna take it out and stuff like that. A lot of things happen in these recessions. So controversy, a lot of noise. Don't worry about it too much. We'll already be in one and it'll be too late. Anyways, dollar cost averaging works pretty well. I covered a lot of things today, but this is the update for today. It's the 1K mark. It's a good milestone here. There will be another milestone which will be like 5K, and another one would be 20K, 10K, not 20K, 10K first, then it'll be 20, 30, 40, 50, and hopefully someday in the near future I'll hit 100K. Who knows? Anyways, if you like this video, give me that thumbs up, subscribe to the channel for the latest updates. If you have any topics you want me to cover in particular, please put a comment down below and I'll try my best. If I have a good knowledge base around it, I might share a thing or two there as well. Anyways, till next time, peace.